Let's Talk Money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Questions when it comes to mutual funds. When to buy a fund? When to exit out of a fund? Should I buy a fund because it's dealing with a sector that's doing really well in the market right now? Should I buy a fund because my friend has an investment and feels it has great potential? Should I exit now because the fund is simply not performing? These are some of the most basic issues and questions that we investors face all the time with respect to our mutual fund portfolios. But is there a bias, an investing or a behavioral bias coming in our mind which is preventing us from really optimizing our portfolio returns? This is the million or maybe the billion-dollar question. And to help me answer this today, I have with me Kaustubh Belapurkar, who's Director of Fund Research at Morningstar. Kaustubh, thank you so much for joining in. Welcome to Let's Talk Money.
Thank you so much, Surabhi, for having me on the show. Super excited to be here.
Absolutely. And welcome back to the studios because, ladies and gentlemen, Kaustubh is coming back, I think, first post-COVID appearance.
That's right.
In person.
Yeah. It's almost like a debut of sorts. So
Fantastic. Yeah. And you picked a really, should I say easy subject to talk about?
Easy?
The most difficult one. I was being sarcastic.
Absolutely.
Yeah.
I mean, I would say that it's, it sounds easy at the surface.
Yeah.
It sounds intuitive.
Yeah.
But actually, like you said, behavioral biases, we're all susceptible to them, right? So be it the most proficient portfolio manager, investment advisors, investors, all of them are susceptible to behavioral biases.
So let's start from the very beginning, right? And the golden rule in the market, which all wise men will tell us, buy when the market is falling and sell when the market is going to an all-time high. It's just easier said than done, isn't it?
Absolutely. In fact, we have all these rules in our mind, but when things are either super exuberant or they're falling, we tend to act exactly in the opposite manner in which we're supposed to act. I think somewhere maybe investors are getting a little more mature as we go along, but I think there's still a fair bit of journey to cover. There are newer and newer investors coming on, and slowly we'll kind of bridge that, what we call the behavioral gap.
Absolutely, absolutely. No, you're right, and I take that point because I think after COVID, if there's one thing that investors are showcasing in their behavior is that one thing's become clear. When the market is showing a major dip, you have to deploy money. And we're seeing that, right? Retail investors have been really drivers of this big 3-year bull run that we've had after COVID. But the question is, when it comes to individual funds, at an aggregate level, yes, I need to buy equity when the market's falling. But when it comes to individual funds, that's when that decision-making gets really complex. Yes. So let's start by understanding this behavioral, investor return gap study that you folks did at Morningstar. What was it all about?
Yeah, sure. So a very interesting study, and we've been doing this globally for many years. And, a couple of years ago, we thought, India's ripe for doing this study. And essentially what it looks to do, we're obviously a significantly growing market in terms of assets and, newer and newer investors are coming in. What the study looks to do is that, if you looked at the published returns of a strategy, and, you can do it across asset classes, and we ran that for the entire set of, be it equity, fixed income, commodity funds, allocation funds, the whole suite of funds, right? There's a published return. I mean, if I, pick up a fact sheet, I would see that here's your 1-year, 3-year, 5-year return for the fund, right? Sure. That is the published return if I invested on day one. Right? Let's assume that a fund returned 15% over the last 5 years. Had I invested 5 years ago and stayed invested for that entire period, only then would I, as an investor, have made that entire 15% return, which is a pretty amazing return to have, right? Yeah. But the challenge is investors come in and out of the fund at different points of time. And more often than not, we spoke about behavioral biases. The moment you see that a particular fund is doing exceedingly well, now that's already passed, right? Yeah. Investors rush into that.
That's when they'll rush in and want to deploy the money.
Absolutely. Yeah. So what we calculate is essentially what is the average return earned by every single rupee invested in that fund. Okay. Right. So let's just take an example that you had say 3 years ago, there was a fund that was very simple illustration. It was a 1,000 crore fund. Okay. And today it's a 10,000 crore fund. Right. Okay. In 3 years it's grown 10x. Right. Okay. Maybe in the year one there was only 1,000 crores, and maybe the return, let's assume, was 30%, right? Okay. Year two, and this is a very simplistic example, but it'll drive home the point, right? It became 20% in year two. Okay. It's kind of been tapering off. And year three, it's 10%. Positive, but it's kind of been falling down, right? Okay. Now you had 1,000 crores in year one, maybe looking at some of that return, another 500 crores of new investor money came in. Now, sitting at the end of year 2, because you're at 30 and 20,
so
really...
when are you assuming this 500 crores came in, looking at the first year return?
Let's just assume for simplicity's sake that it came in through average over the period
over the
of that
first year of that fund.
Right? Yeah.
Okay.
But a very small amount came in, right?
Okay.
But a bulk of the money, say, came in between year 2 and year 3. Say about 8,000, 7,000.
Once people saw, oh, this fund is giving 30%,
Absolutely.
I should get in.
Absolutely.
So year 2 is when people started,
Correct.
jumping on.
And now, when we think about the return series, right? If you had stayed invested through the entire period, you made about, if my math is right, about 72% absolute return. If you came in at the start of the fund and stayed for the entire 3 years. But if you came in only after 1 year, I think that number would drop to about 32%, right?
Because you missed the first 30%.
Absolutely.
Yeah.
But if you came in at the end of the second year, you made only 10%, right?
Correct.
And if a bulk of the money is actually coming during that period, after that 30 plus 20, 30 into 20 is actually already been delivered, the bulk of the investors have actually not made that 72%. They're probably at 14, 15%. So that's the concept of investor return. So while the printed return for a fund may look great, if the assets have grown significantly, the investor return is going to be significantly low.
That's a really interesting point. Actually, we're putting some graphics up on the screen which illustrate some of the sort of takeaways from this particular study, where in 3 years the fund return is 10.45%, whereas the investor return is just under 9%. In a 5-year period, the fund return is about 8.8% rounded off. Investor return is 7.5%. First of all, is this like diversified equity funds at an aggregate level?
This is actually for the entire industry.
Okay.
So would be equity funds, sectoral thematic funds,
okay.
Fixed income funds, commodity funds, and allocation funds.
Everything put together.
But if you were to actually break it down, when you think about what are, say, for instance, equity funds, you would typically have higher gaps because it's a more volatile asset class. Even within equity, typically more narrower thematic funds would actually have a much significantly higher gap as compared to, say, a flexi cap or a large cap.
Got it.
So I think those are some of the observations that very clearly came out. Because these kind of decisions are very fraught at timing risk, right? And the greater the lumpiness of the return, the greater the gap that can be what an average investor earned versus what the fund actually.
Okay, so I think the numbers on the screen really tell us that not necessarily will you make enough return or enough money in a fund that otherwise is showing excellent printed returns. So then how to solve for it? Simple question. What do we do?
Again, I think it's going back to basics, right? The first thing is always think about, the holy grail is asset allocation, right? Thinking about your risk return objectives, time horizon, always asset allocate. Always kind of build that in that, if markets are overheated or cheap, like you alluded to, rebalance. And have that, automatically set in terms of, a rule-based, or you have an advisor who helps you do that. So that, there's no, you reduce the amount of human element to that decision making, right? Because if you think I'm going to do it on the fly and that, okay, let me wait for the market to fall.
Which is what most people think of doing.
Most people think of doing, right? Put those simple rules down and try to stick to it as much as possible. It goes a long way in building that discipline. I think the third very important, very useful tool that the industry is really, built very beautifully is SIPs, right?
The systematic investment plan.
Absolutely. It's that autopilot mode where you keep putting in the money. You're not doing that allocation.
Timing of the market.
Absolutely. Which takes care of a lot of those behavioral risks. And I think the fourth, the most important thing, typically most investors, when you think about building, say, an equity portfolio, largely would be best served by buying a diversified equity fund. Could be across, various market cap buckets. Try to limit, very narrow sort of investment universe funds like Thematics or Sectoral, because those are susceptible to large timing risk.
US technology fund or a, or a NASDAQ fund and all of that.
Yeah, or an infrastructure fund.
Or an infrastructure, a PSU fund.
Yeah, absolutely.
I have to tell you, that's the hard part because they look fabulous. They look hot, right? When NVIDIA is surging 50% and then you are in a fund which is tracking the US tech boom. So, let's come down to that question now. On thematics and sectorals, and that's sort of a large part of this conversation as well, because the temptation is so significant, to go for these funds. How should one approach them, and what are the pitfalls?
So I think the most important thing about, sectoral funds, like I said, there are two ways of doing it, right? So one is, remember, when you're buying into a diversified equity fund to start with, the manager, who's a professional money manager, is also taking underweight or overweight calls in a particular sector, depending on their, sort of conviction levels, right? But they're doing it in a sort of gradual, graded manner. It's not a binary decision, right? Because if you're buying, say, a technology fund, right, today, you're going all in, I mean, imagine if that's your only fund in the portfolio, right? That's all exposed to one sector. Now that's
super high risk.
Absolutely, right? But if you buy a diversified equity fund, typically, the manager will have guardrails saying that, okay, look, I'm going to maybe go overweight, underweight, 3 to 5% on a particular sector, right? So, I mean, there are reasons why those guardrails are built in that. So no one goes gung-ho and over-allocates to a particular sector, right? So a diversified equity fund is actually a great way to even take exposure where a professional manager is taking those.
Let the professional do the job.
Yeah.
Don't try and sort of go on funds. Kaustubh, I want to talk about the study that you folks did on showing this whole entry-exit business, how that becomes trickier for sectoral and thematic funds, right? Because they're narrow, they can have a couple of months of fabulous performance and then a couple of, months or years when they're complete duds. Isn't that so?
Yeah, absolutely. So, I mean, we speak about, that sectors go through periods of outperformance and underperformance. I mean, the winners and losers keep rotating, right? So, I mean, if I just think of a classic case was technology funds, real life example, post-COVID, right? There was a significant run-up in the tech sector in the years of 2020, 2021.
Yeah.
Probably, amongst the best performing sectors during that period of time, right? And what happened was exactly, kind of the illustration that I gave.
Yeah.
Right?
You know what? Hang on. Let me pull that illustration up. We'll just put it up for our viewers as well. There's a heat map of sorts which helps us understand why it would be wrong to assume that a single sector can keep consistently outperforming in the market for long periods of time. So let me just quickly go back and talk about this particular map that you were referring to. So this is what we've got. We've basically looked at data from 2019 onwards. This is pre-COVID, and we're talking about, let's say, the top 5 performing sectors in any given year. So how to read this? Very simple. We go back to 2019, consumer durables was the best performing sector that year. Was it the best performer in the subsequent year? The answer is no. Was it the top performer in 2021? The answer is no. In fact, this sector was constantly dipping in the subsequent years. Let me take one more example. Banking was number 2 in 2019, but it's nowhere in the top 5 in 2020 or in 2021. It only comes back in 2022. So again, that's where entry and exit. I mean, do you and I know when to get in and when to get out? Let's take one more example. We all remember what happened to healthcare during COVID, the peak of the crisis. Pharma stocks were really going through the roof. Look at that, 60% return in 2020. But what happened after that? Healthcare is absolutely nowhere to be found in 21, 22. And it comes back in the top 3 in 2023. So I guess, the short point, Kaustubh, is that it's very difficult to predict whether some of these patterns and some of these moves, whether they can last, right? Because now we're in a space where CapEx and infrastructure is the big theme. So I guess it would be very natural for someone to believe that they should have an infra fund in their portfolio, right?
Yeah. It's natural to believe. And, honestly, they should have believed that maybe 3 years ago.
Oh, okay.
Because again, I mean, if you look at the chart right here, right? I mean, you see the cap goods has now probably been the best
40%,
performing.
yeah.
Absolutely.
Yeah.
So it's always typically what happens. And, the example that I was using, say, for instance, technology. We saw this great run up in IT, and you can see that on the chart, amongst the top 5 sectors in 2020,
after healthcare, it's IT next, yeah.
There was hardly any money lying in technology funds at the start of 2020. Even till the end of 2021, there was only some money building up. Probably the slightly more nuanced investors came in. A bulk of the money came in 2022 after the rally had already happened, right? So when we ran the same study for, I spoke about that there can be larger gaps for sector funds. It was staggering, right? So technology over a 3-year period, and this is data as of June 2022, the CAGR for the funds was about 27%. Right?
So the fund returns are 27% over 3 years. Yeah. Fabulous.
Fabulous, right?
I'd take it with both hands. 27% in 3 years,
absolutely.
right?
But the average rupee investor, the investor return, was 3.2%, right?
Explain that. How is that possible?
Right?
How is the investor return just 3%?
Because, the same example that I used, right?
Yeah.
There was about, assume that there was a very small amount of AUM in tech funds at the start of 2020. A little bit came in 21. Bulk of the money came in after the rally had already played out, right?
Yeah.
And obviously then investors were staring at negative returns. In fact, now you would see that money is actually slowly trickling out of these funds, right?
Yeah.
Now that's the challenge. The entry was wrong. They're probably exiting also the wrong time. You never know when tech could turn around.
It's like entering a restaurant when the last order has already been called, right? Or when the music is just about stopping, that's when you enter a party. So not much fun. Okay, we have to take a quick break on that note, but we have lots of viewer queries as well on sectoral funds, and we'll try and get Kaustubh to answer some of those questions in just a bit.
Let's talk money.
Welcome back. You're with us on Let's Talk Money. And this week we are asking whether human behavioral biases have a way of complicating the returns that we mutual fund investors make, especially when it comes to sectoral and thematic funds. We have some questions coming in. And of course, Kaustubh from Morningstar is here to answer them. So, Kaustubh, get ready. We have Samrat with us on the phone line now. Samrat, hi. How can we help you?
Hi, I'm Samrat from Bangalore, and my question is that till few years back, PSU stocks as a category were laggards. But in recent past, they had a bull run. Is the best time behind us, or there will be extended outperformance cycle in this category? Should I invest as an SIP investor?
Samrat, there you go. Now you're asking that billion-dollar question, right? That I think everybody on the street has on their mind. And we keep debating this with, guests across the board on CNBC throughout the course of the day. But for what it's worth now, Kaustubh, I think it just kind of, tells us how investors are thinking right now. There's been this unbelievable gravity-defying move in PSUs. Yep. And you keep thinking maybe it's getting excessive. The next year you see another 30%, another 50%. What would your advice be?
It's a very tough thing to kind of, and you're right, because if you just look at the past 1 year returns, it's, I think, 100% plus on the index with a lot of funds. And you feel like you've missed the bus. What do I do? Do I get in? The challenge, and when we think about narrow investing now, PSU obviously encompasses companies from across sectors, but it is still, in a sense, narrower segments,
universe,
right? You have your industrials, your power, utilities, and all of those. So I think it's not a full encompassing universe. And what's happened is that, like Samrat rightly said, 18 to 20, the entire PSU pack underperformed, right? And they were literally playing catch up over the more recent years, and that's why we've seen this significant run up. And especially in certain pockets, some of these sectors itself have done exceedingly well, and they've been large beneficiaries of that, right? Power, cap goods, and some of these. So I think looking at past performance and purely investing basis that, I would definitely not advise that, right? And like I said, what you can do is take a cue from what an active manager is doing, right? Typically, you would see them moving ahead of time, right? You would see that active managers have already started loading up PSUs maybe a couple of years ago.
That's
right. So I would actually, if you're a more nuanced investor, you can actually take a cue from what the professional money managers are doing. Now, I'm not saying that, the run is over. No one knows that, right? Because it's market forces at play. Even the best of money managers can't tell you that now, okay, time's up and let's
you would be wary?
I would definitely be wary. Because like I said, don't do your rearview mirror driving and, buy what's done well. Rather, maybe, like I said, either look at what active managers are doing or, think of something that's underperformed in the recent past. Because, like the chart that we showed a little while back, the winners and losers keep rotating.
They keep changing,
right? Correct. The best advice, to be honest, is don't buy into sectoral thematic funds. If you do have that urge to try something different rather than the boring diversified equity funds, I would say use some of these tips and tools. Typically, don't buy more than 5% in a sector or theme.
Don't buy more than 5% in a particular
sector or theme.
Okay.
Not more than 10%. So it's almost like your risk capital, so to speak. Right. Be very, very patient with your investing, because if you're buying into a sector that's done well recently, more likely than not, it's going to underperform in the near future. But if you stay invested, when the cycle comes back,
eventually turns, so
you will do well, right?
Okay.
And the best way of doing is SIP, right? Again, you're kind of removing that risk of market timing.
In and out.
Absolutely.
Got that. Okay, some more questions. There's Javal Darji, who's written in, he's put a question on Instagram. By the way, you can reach us on Instagram, on X, on all these social media platforms. Now, he's asking if it's the right time to start investing in the defense sector. There you go. Let me take one more question on similar lines. Akhil is asking that he wants to invest in the Atmanirbharta and the manufacturing theme. He's saying he's missed the bus and he would like to ride on the next one super early. There you go, Kaustubh. I don't need to say anything, right? It really sums up the investment sentiment out there.
Yeah, absolutely. So I think, and I'm going to play a little bit of both sides of the coin here. The first question especially, I'm probably coming from a place because I'm a Fauji kid, right? And I think the one good thing, obviously, what you've seen, it's a slightly different opportunity set. It's a very niche opportunity set. But I think, obviously, the whole Make in India, you're making warships, you're making fighter jets in India, which didn't exist. So it's an interesting opportunity. But should I get in now? How should I get in? I think that is a very, very tricky part, exactly alluding to the whole sector, the sector bets that you want to take. If you do want to take some risk capital, again, follow the same rules that I spoke about.
Not more than 5% of your portfolio
5%,
should be, let's say, defense or any particular sector.
But again, you will have active managers, especially say for manufacturing, right? I mean, you talk to any active manager, they're super gung-ho on manufacturing. So you're going to get exposure any which ways.
Nobody says don't invest in manufacturing. Nobody says defense is a bad theme.
Yeah, absolutely.
But the question is how to play with it
How do you play it, right? How do you play it?
Yeah.
So if you want to take a very specific exposure, maybe a little bit on the margin, but otherwise your diversified equity fund's going to do exactly that for you, right? Especially a more broader theme like manufacturing, which encompasses, across, say, consumer cyclicals, basic materials, cap goods, industrials, like the whole gamut of that, right? Managers are already doing that. So you don't need to buy a separate fund necessarily to take exposure to that.
Yeah. So I mean, I'll just add my 2 bits. Just yesterday, I was looking at Cochin Shipyard, stock which is in the PSU defense basket. It's gone up 700% in the last 12 months. That's like 8 times. So if you want to, buy into a theme or a stock or, something that's already gone up 7-8 times, you have to perhaps exercise plenty of caution.
Yeah, you got to have guts. I mean,
exactly. It's not for the faint-hearted.
Yes.
Absolutely. Okay, I think we have time for one last question on the show. We have Dipali. Dipali has written in with a query saying that I have some lump sum money to invest, but I'm not sure where to put it in. Dipali, if you've been listening to the conversation, you will know that Kaustubh will tell you to put it in diversified equity funds, right, Kaustubh?
Absolutely.
But tell us which ones, because you guys at Morningstar do a lot of rankings. So what's looking good to you now?
I think just taking one quick step back and just some pointers to Dipali, I think the first thing she needs to think about, what's her time horizon? What's the kind of risk appetite budget that she can take for investing?
Because lump sum at 23,000 Nifty. So
absolutely. She needs to think about that, right? Because, pockets like small and mid caps, while they're great long-term wealth creators, someone tells me I have a 5-year horizon, can I buy small and mid caps? I would probably urge a fair bit of caution on that, right?
Okay.
But that said, I mean, if you were just thinking about some of the funds that we like, so, if you're looking for a large cap fund, I think one of the funds that we really like is the ICICI Prudential Blue Chip Fund. Well managed, very experienced manager, great team backing him up. So that's on the large cap side. On the the flexi cap side, which goes across the market cap with the large cap bias, there's a Kotak flexi cap. Again, Harsha, extremely experienced manager and very well run strategy. On the mid cap, if you would like to buy, there's the HDFC mid cap opportunities run by Chirag. Again, a superb team sort of running that strategy. So I think these are some of our really like funds in this space.
Okay, so there you go. Some options if you want to stick to plain vanilla, old and boring, diversified equity funds, which is what Kaustubh recommends, then you have some options there. Well, fantastic conversation, Kaustubh. Thank you so much for taking all the time and joining in. And I think we'll do well keeping some of those caveats and that caution in mind when it comes to sectoral funds.
Pleasure as always. Thanks, Surabhi.
All right, and with that, it is a wrap on this edition of Let's Talk Money. Remember, keep sending us your questions and queries. Whatever you want to know is what we will answer. See you again next week on the show.
Let's Talk Money